The recent analysis of the U.S. business cycle presents a nuanced picture, with key economic indicators showing mixed signals. While the S&P 500 index has demonstrated a robust recovery since the economic expansion began in May 2020, reflecting one of the sharpest rebounds since 1970, this optimism does not uniformly translate to the broader economy. The divergence between stock market performance and real economic indicators highlights complexities in the current economic environment. Notably, non-farm payrolls have shown a strong recovery, marking the most significant rebound since the last recession ended. However, the pace of job growth is showing signs of deceleration, raising concerns about its sustainability as the business cycle matures. Consumer spending, another critical economic indicator, has also experienced a remarkable recovery, ranking as the second strongest since 1970, yet recent data suggests that this upward trend may be losing momentum, potentially influenced by factors such as tariffs and broader economic conditions. Meanwhile, personal income growth remains sluggish, lagging behind other indicators and posing a risk to economic stability if employment growth falters. Industrial output, which had rebounded strongly post-pandemic, is now showing signs of stagnation, posing a cautious outlook for sectors reliant on industrial activity. These mixed signals underscore the importance of closely monitoring economic data in the coming months to assess the durability of the current expansion and its implications for future economic policy and market strategies.
Finance Minister Nirmala Sitharaman has introduced a bill in the Lok Sabha proposing amendments to the Insolvency and Bankruptcy Code, IBC, which has been referred to a select parliamentary committee for review. The amendments aim to refine the IBC framework, focusing on creditor-led resolutions, cross-border insolvency, and corporate group bankruptcy. This initiative is intended to streamline the resolution process for bankrupt firms, enhance creditor recoveries, and reduce the caseload of the National Company Law Tribunal, NCLT, by facilitating out-of-court settlements. The proposed changes include a cross-border insolvency framework modeled on United Nations guidelines, which would allow easier access to overseas assets of distressed companies and foster international cooperation in insolvency proceedings. Additionally, a voluntary group insolvency framework is set to enable joint resolution of financially troubled entities within a corporate group, recognizing their operational interdependencies. These amendments, following 6 previous iterations since the IBC's inception in 2016, signify the government's ongoing efforts to adapt the bankruptcy ecosystem to evolving challenges and expedite asset resolution processes.
IQSTEL Inc. has announced a significant milestone, reporting July 2025 revenues of approximately $35 million, which propels the company past its $400 million annualized revenue run rate, 5 months ahead of schedule. This achievement positions IQSTEL to meet its full-year revenue goal of $340 million and supports its ambitious target of reaching $1 billion in revenue by 2027. The revenue stream is primarily driven by telecom services, which constitute 80% of the mix, with the remaining 20% coming from fintech. The company's strategic focus on growth and profitability has been bolstered by a reduction of nearly $7 million in debt, with half converted into preferred shares, indicating stakeholder confidence in IQSTEL's long-term prospects. IQSTEL's recent Memorandum of Understanding with Cycurian Inc. marks a strategic expansion into AI-driven cybersecurity solutions, aiming to enhance its service offerings to telecom operators, governments, and enterprises globally. This move is part of IQSTEL's broader strategy to not only grow in size, but also to establish itself as a leader in the industry with a focus on shareholder value creation. Institutional investors have shown confidence in the company by increasing their holdings, further evidenced by a positive buy rating from Litchfield Hills Research, with a price target of $18 to $22. As IQSTEL continues to prepare for sustained growth, its strategic initiatives are designed to ensure the company is well-positioned to lead the industry into the next decade, leveraging its scalable business platform across 21 countries.
Sarepta Therapeutics is currently under scrutiny as Faruqi and Faruqi LLP investigates potential securities law violations by the company. The investigation centers on allegations that Sarepta made false or misleading statements regarding the safety of its gene therapy product, Elevidys. Significant safety concerns have emerged, highlighted by patient deaths and severe side effects that have led to halted clinical trials and regulatory reviews. Following these developments, Sarepta's stock has experienced substantial declines, with a notable 42.12% drop on June 15, 2025, after announcing the suspension of Elevidys shipments for non-ambulatory patients. The legal proceedings could have significant implications for Sarepta and its investors. The U.S. Food and Drug Administration, FDA, is also involved, having issued a safety communication about the risks associated with Elevidys. This ongoing situation is critical for shareholders and potential investors, as it may affect the company's financial health and stock performance. The outcome of the class action lawsuit and regulatory reviews will likely shape Sarepta's strategic direction and investor confidence moving forward.
Dell Technologies Inc., NYSE Dell, has seen a notable increase in institutional investment, with Trajan Wealth LLC boosting its stake by 24.7% in the first quarter, now holding 50,402 shares valued at approximately $4.59 million. This move is part of a broader trend, as 76.37% of Dell's stock is currently owned by institutional investors and hedge funds. The company's stock has been receiving attention from analysts, with several brokerages such as Barclays, Bank of America, and Morgan Stanley raising their price targets, reflecting a generally positive outlook. Dell's stock performance has been robust, with a market capitalization of $93.88 billion and a one-year high of $147.66. Suggesting strong market confidence. In parallel, insider transactions have been significant, with CEO Michael S. Dell selling 10 million shares, reducing his stake by 27.85%. This sale, alongside others from company insiders, totaled nearly $1.58 billion in the past 3 months. Despite these sales, insiders still own 42% of the company, indicating substantial internal confidence. Dell's recent quarterly earnings reported a $1.55 EPS, slightly below the consensus estimate, but revenue exceeded expectations at $23.38 billion, marking a 5.1% year-over-year increase. The company also announced a quarterly dividend of $0.525, reflecting a dividend yield of 1.5%, which is an attractive aspect for income-focused investors. Overall, Dell Technologies appears to be in a strong financial position, bolstered by institutional interest and analyst optimism. However, the insider sales might indicate some caution among company executives. The company's strategic focus on its Infrastructure Solutions Group and Client Solutions Group continues to drive growth, positioning Dell well in both the U.S. and international markets.
United Health Group Incorporated, NYSE-UNH, has seen a notable increase in institutional investment, with Trajan Wealth LLC boosting its stake by 14.3% in the first quarter of 2025. Trajan Wealth now holds 44,619 shares valued at $23.37 million, making United Health Group its 20th largest position. This move is part of a broader trend, as 87.86% of United Health Group's stock is owned by institutional investors. Despite this institutional confidence, the company's recent earnings report showed a miss, with Q2 earnings per share at $4.08 falling short of the $4.45 consensus estimate. Revenue for the quarter was $111.62 billion, slightly below expectations, though it marked a 12.9% increase year-over-year. United Health Group's stock performance has been under pressure, with its shares opening at $252.44, significantly lower than its 12-month high of $630.73. The company's price performance reflects a broader market sentiment, with analysts offering mixed ratings. Notably, Argus downgraded the stock from buy to hold, and TD Securities adjusted their price target from $520 to $308. Despite these challenges, United Health Group increased its quarterly dividend to $2.21 per share, reflecting a dividend yield of 3.5%, which may appeal to income-focused investors. The company's diversified operations across its United Healthcare and Optum segments continue to provide a robust platform for future growth, although market volatility and sector-specific challenges remain key factors to watch.
Regal Resources' initial public offering IPO witnessed robust investor demand, with the issue being subscribed nearly 6 times on its opening day. The IPO, which is open for subscription until August 14th, saw significant interest across all investor categories, including retail, non-institutional investors, NIIs, and qualified institutional buyers, QIBs. The retail portion was subscribed 5.58 times, NIIs 10.77 times, and QIBs 2.94 times. A total of 21,568 bids were received against the 99,664 shares on offer, highlighting the strong market interest. The IPO, valued at 306 crore rupees, consists of a fresh issue of 210 crore rupees and an offer for sale of 96 crore rupees, with a price band set between 96 rupees and 102 rupees per share. The grey market premium, GMP, for Regal Resources stood at 25 rupees per share, suggesting a potential listing price of 127 rupees, or a 24.51% premium. However, analysts caution investors to consider the company's fundamentals and their risk appetite. Rather than relying solely on GMP, the company plans to use the IPO proceeds for debt repayment and general corporate purposes. Despite its capital-intensive operations and exposure to agricultural cycles, Regal Resources' strategic location and diversified customer base are viewed as strengths. Most brokerages, including Anand Rathi and Reliance Securities, have given a subscribe for long-term rating, indicating confidence in the company's growth prospects, despite the fully priced valuation at a PE of 21.9 times based on projected FY25 earnings.
Trajan Wealth LLC has increased its stake in Wells Fargo & Company, NYSE WFC, by 13.7% during the first quarter, acquiring an additional 9,275 shares, bringing its total holdings to 76,965 shares valued at approximately $5.53 million. This acquisition is part of a broader trend among institutional investors, with entities such as Safeguard Investment Advisory Group, LLC, Summit Wealth and Retirement Planning, Inc., Nawam LLC, and Zulo Investment Group, Inc. also increasing their positions in Wells Fargo. Institutional ownership in the company stands at a substantial 75.90%, indicating strong confidence in the financial services provider's performance and potential. Wells Fargo's recent financial performance has been robust, with the company reporting a quarterly earnings per share, EPS, of $1.54, surpassing analysts' expectations of $1.41. The company's revenue for the quarter was $20.82 billion, slightly below the $20.83 billion forecast, but reflecting a year-over-year increase of 0.6%. The firm also announced a dividend increase to 45 cents per share, representing a 2.3% yield, and unveiled a $40 billion share repurchase program, suggesting management's belief in the stock's undervaluation. Analyst sentiment remains mixed, with a consensus rating of moderate buy and a target price of $80.39, reflecting a cautious optimism about the company's future prospects amidst a competitive banking sector.
The main financial event highlighted is Trajan Wealth LLC's slight increase in its stake in the Walt Disney Company, NYSE DIS. As reported in their latest SEC Form 13F filing, Trajan Wealth's holdings rose by 0.2%, now owning 83,110 shares valued at approximately $8.2 million. This move is part of a broader trend where multiple institutional investors, such as J. Safra Saracen Holding AG and Rayos Capital Works Inc., have either increased their positions or newly invested in Disney, reflecting continued institutional interest in the entertainment giant. Currently, about 65.71% of Disney's stock is held by hedge funds and institutional investors, indicating strong institutional confidence in the company's prospects. In terms of market performance, Disney's stock opened at $112.60, with a market capitalization of $202.45 billion and a price-to-earnings ratio of 17.65. Analysts have shown optimism towards Disney, with Evercore ISI and UBS Group raising their price targets to $140 and $138, respectively. The stock has an average rating of moderate buy from analysts, with a target price of $131.18, reflecting positive sentiment despite some neutral ratings. Disney's recent quarterly earnings exceeded expectations, reporting $1.61 EPS against a consensus of $1.45 and revenue of $23.65 billion, slightly below estimates but up 2.1% year-over-year. This performance suggests resilience in Disney's diverse entertainment and media operations, potentially bolstering investor confidence in its long-term growth trajectory.
Philip Morris International Inc., NYSE PM, has seen a notable increase in investment from Trajan Wealth LLC, which expanded its holdings by 12.7% in the first quarter, bringing its total investment in the company to $13.41 million. This move reflects a growing interest from institutional investors, as evidenced by other firms like Pacifica Partners Inc. and Redmont Wealth Advisors LLC also increasing their stakes. The broader institutional ownership of Philip Morris now stands at 78.63%, indicating strong confidence in the company's market position and future prospects. Philip Morris recently reported robust quarterly earnings, with a $1.91 earnings per share, surpassing analysts' expectations. The company's revenue increased by 7.1% year-over-year to $10.14 billion, although it fell slightly short of the consensus estimate. Despite a negative return on equity of 120.86%, the firm maintains a healthy net margin of 9.03%, and analysts forecast an annual EPS of 7.14 for the current fiscal year. The company's strategic shift towards a smoke-free future, with products like IQOS and ZYN, continues to attract positive attention from the market, evidenced by the majority of analysts maintaining a buy rating and a consensus target price of $186.27. Philip Morris also announced a quarterly dividend of $1.35 per share, translating to an annual yield of 3.2%. This payout underscores the company's commitment to returning value to shareholders, even as it navigates the challenges of transitioning away from traditional tobacco products. The dividend payout ratio currently stands at 102.66%, suggesting a strategic emphasis on rewarding investors while balancing its innovative product development initiatives. Overall, the financial community remains optimistic about Philip Morris's strategic direction and its ability to adapt to changing market dynamics.